Hello everyone. The content of today's video is why we should wait for a price pullback. Wait for the price to retest before entering a trade instead of entering on a breakout. Let's get started. Before diving into the main content, we need to review the basics first. What does it mean to enter a trade on a price retest, and what does it mean to trade a breakout? To make it simple, let's look at a chart. An uptrend occurs when the price forms higher highs and higher lows. The low after is higher than the low before. If this uptrend continues to rise, the price cannot break below this key level. You want to enter a trade like the trades we've done on this channel, which means waiting for the price to test or retest. We only enter a trade when two conditions are met. First, you must have a basis to predict that this uptrend will continue to rise by using multiple time frames. Second, the price must pull back before we enter a trade. What if the price doesn't pull back? Then we simply don't have an opportunity to trade. If the price doesn't pull back, do we miss the trade? And so you decide not to miss any trading opportunity in the market by entering trades based on breakouts. At this point, you don't need to worry about the pullback or analyze whether this uptrend will continue rising or not. You simply place a buy stop order up here, because if the price breaks through this high, it means the market has formed a higher high, higher than the previous high. It's an uptrend, no need for further analysis. But there's a significant drawback, which is, for any trade to have a high win rate, we need to place the stop loss at a safe level. The safest place is below the key level. This leads to the fact that the stop loss becomes this large, and a good take profit point will have a very low risk to reward ratio. The lower the risk to reward ratio, the higher the win rate you need to achieve consistent profits over the long term. Maintaining a high win rate over time is extremely difficult. It's much harder than entering trades with a lower win rate, but a higher risk to reward ratio. And that's the main reason I almost never place buy stop orders. Not to mention, in the market there are thousands of false breakouts. No matter how you enter a trade, you can still be affected by false breakouts. You can still fall into the trap of false breakouts. So how do we avoid false breakouts? I have to say, unfortunately, it's almost impossible. The only way is to minimize it by setting our stop loss wider, more comfortable, that's all, and with placing buy stop orders based on breakouts to be safe and avoid false breakouts. The entry point needs to be even further. The stop loss is already this wide. How can we possibly win? That's why I don't like trading breakouts. Instead, I choose to trade pullbacks and retests and make that my guiding principle throughout my trading career. Okay, now let's go back to our familiar entry method. There are two things I want you to note. First, if you want to place a limit order to buy in an uptrend, you only do so when you've analyzed multiple time frames and have a basis to predict that the uptrend will continue to rise. At that point, you place a limit order to buy. Second, if you've analyzed multiple time frames and still can't determine if the uptrend will continue or not, then don't enter a trade recklessly. Wait for confirmation. We wait for confirmation by waiting for the price to break through the key level of the pullback trend before entering a trade. What if the pullback trend has no clear highs or lows? It pulls back in a straight line like this. What do we do then? We drop to a lower time frame until we can clearly see highs and lows and the market structure. Then we apply what we just discussed. Wait for the price to break through the key level of the pullback, then enter the trade. The theory is pretty straightforward, nothing new here. But to understand it deeply and thoroughly takes time. With this perspective, now let's move on to practice. This is the pound sterling to US dollar pair, and I'll only apply what I've shared so far. Trading with two time frames, because it's the simplest and easiest. I use two time frames. The entry time frame is 5 minutes, and the higher time frame is the 15-minute time frame. Before diving into the video content, I have a warning. If you're a beginner without enough experience and haven't achieved consistent profits on higher time frames, don't trade on lower time frames like the 5-minute time frame. Trade on the 1 hour, 15-minute, or 4-hour and 1-hour time frames. Although reading the market is the same across time frames, it's identical. But on lower time frames, everything happens very quickly, making it hard to analyze carefully and easy to FOMO into reckless trades. So why did I still choose these two time frames? Because these are my familiar entry time frames. I'm comfortable with them, so they give me a sense of ease in creating and filming this video. If I tried to find examples on higher time frames for this video, it would be too much effort and lack emotion. Reading the market and candles is the same across time frames. So treat this as a video about mindset, trading, and reading candles. Don't copy my time frame and trading style. First, we always look at the higher time frame first, the 15-minute time frame. On this time frame, we identify a price zone, a key level, also known as a resistance. Let's zoom out for a broader view. And we see this is a high, a key level, a resistance. At this point, we expect the price to reach this key level and reverse. But remember, this is just an expectation. We don't enter a sell trade right away. We need to wait for confirmation. When the price reaches this key level, for the process, we switch to a lower time frame, the 5-minute time frame. This is the 5-minute time frame, showing an uptrend. Now we look for the key level of this uptrend. Look at this area. It's clearly a consolidation zone, not a high or low. But looking at this, I believe many of you would think this is the key level. But for me, I don't consider this a pullback. I consider this entire price zone a consolidation zone. A bit tricky, right? New traders often get confused. Confused because we look at candle colors. Confused because we count candles. But remember, we must not get confused. Look at this, it's green and red alternating like this. This is just a consolidation zone, not a pullback or high-low structure. For me, I consider this the key level. In the market, there's no single correct method or single correct approach. There's only the safe approach. I choose the safe approach. This is the key level. I wait for the price to break through this key level before looking for a selling opportunity. If the price hasn't broken through, I wait. I don't buy or sell. In the end, it doesn't go down but goes up like this. So, this key level on the higher time frame failed to hold the price. I switch back to the higher time frame to check. This high failed to hold the price. I continue to zoom out to find the next resistance zone. Here. This is a high. Just identify the high and draw it. The price is now close to this key level, and I expect it to reverse here. But remember, these are just expectations. We shouldn't enter a trade right away. We need to wait for confirmation, and for the process, we switch to the lower time frame, the 5-minute time frame. On the 5-minute time frame, we look at this. No need to hesitate anymore. It's as clear as a textbook. This is the key level of this uptrend. At this point, I wait for the price to break through this key level. Before entering a trade, if it hasn't broken through, we don't buy or sell. The price moves for a long time. At this point, it still hasn't broken through this key level. But there's a change here. The key level in this case was here, but has now shifted to here. This is the new key level, and if the price breaks through here, I'll look for a selling opportunity. Finally, the price breaks down through this key level. I know you hate waiting. I do too. I don't like waiting. But remember, patience is the key to success in trading. Patience is the key to success in trading. Don't lose patience. The price has now broken down, meaning the uptrend has reversed into a downtrend. At this point, what do we have? We have the price reaching the key level of the higher time frame. The uptrend has reversed into a downtrend. So at this point, we look for a selling opportunity with an extremely high win rate, extremely high. Okay, the trend has reversed. We don't care about what happened before. We only focus on this downtrend. So with this downtrend, it moves down like this. Honestly, I'm wary of charts that move down like this. In this area, this is market noise. If you're a new trader, I believe looking at this, it's very easy to get confused, very easy to make mistakes, often in this case. But for me, I believe this entire price zone is a consolidation. And this is an old low. In this market scenario, it moves like this. It moves like that, so this is the key level. Why do I consider this entire price zone a consolidation zone? It's not a pullback or a high-low structure. Look closely. Pause the video and look closely at each candle. Especially the pullback candles, the green pullback candles. There's only one pullback candle. Look closely. Okay. Keep waiting. The price is now pulling back up. Where does it pull back to? It pulls back to one of two places. First, the key level. Second, the old low. At this point, we have two options. Enter a sell trade at the old low. Place a sell order right at this old low. Stop loss just above the key level. This is a safe stop loss. We sell downward. But in this case, the stop loss is too wide. The stop loss here is 35 pips. 35 pips isn't a huge stop loss, but 35 pips on a 5-minute time frame is a wide stop loss. I never enter a trade with such a wide stop loss. We won't enter this trade. We can choose another option, which is this option. Enter at the old low, assuming the price only pulls back to the old low. And if this trade loses, enter another trade at the key level. Because the risk to reward ratio is high, so even if this trade loses, it's fine. This trade will cover it. But we also don't enter a trade without a solid basis like this. The stop loss here isn't very safe, so I need another confluence factor. Another factor, which is Fibonacci. Measuring Fibonacci, we see this old low. coincides with the Fibonacci price zone from 0.5 to 0.618. This is a positive factor for entering a sell trade right at this old low, and choosing the second option. If this trade loses, enter another at the key level. Scroll down. Now we have an entry point. We have a stop loss point. So where do we take profit? Before discussing take profit, let's review the theory. This uptrend reverses into a downtrend, so where will this downtrend go? This downtrend will move to the starting point of the uptrend, which is here. Here, let's move from theory to practice. This uptrend reverses into a downtrend. According to theory, it will move down to here, the starting point of the uptrend. Very basic, right? But we shouldn't be too complacent. Before doing anything, always remember to check all time frames to ensure we're viewing the market with an objective perspective. Let's switch back to the 15-minute time frame. This is the key level of the uptrend. We'll only take profit at this old low because we choose a safer option. We don't get greedy. Choosing the safe option, take profit here. Based on our analysis, we'll take profit here. Take profit here. Achieving a risk to reward ratio of 1 to 6.7, a very high ratio. But if you're a beginner, you won't be able to hold trades with such a high risk to reward ratio like this, because the price rarely moves straight down like this. It's very rare. Usually, it moves like a wave, up and down. If you hold a trade this long, every time the price pulls back, your psychology becomes very nervous, anxious, fearful. You want to cut the trade immediately because you're afraid of missing the opportunity or losing profits. So we won't take profit up here, we'll take it closer. So where do we take profit? According to theory, the safest is to take profit at this old low. But taking profit at the old low only gives a risk to reward ratio of 1 to 1, very low, and when entering a trade, if the trade doesn't have a risk to reward ratio of 1 to 2, we shouldn't enter. So what do we do? At this point, recall my video on taking profit with Fibonacci. I'll use Fibonacci. Now I'll take profit at this yellow zone. This yellow zone gives a risk to reward ratio of 1 to 1.8. It's still not ideal. Take profit at this red zone, achieving a risk to reward ratio of 1 to 2.7, which is better. I choose to take profit at the red zone. At this point, the price hits the entry point and moves down. I move my stop loss to the entry point. Now, what's new here? The key level in this case was here, but has now shifted to here. This is the new key level in the market. It moves like this. And this is the old low. Let's try measuring Fibonacci again. The old low coincides with the 0.5 Fibonacci zone, a positive factor. Continue doing the same as before. Sell here. Take profit down. Take profit at this old low, achieving a risk to reward ratio of 1 to 2.2. I won't use Fibonacci anymore, I'll take profit at this old low. This trade is hit take profit. This trade is still running. At this point, there's a question. Has this low been broken or not? Looking at this price zone, honestly, I'm not confident. For me, this area is very hard to tell if it's broken or not. When we trade, we can skip unclear cases like this. If it's unclear, we don't know, and if we don't know, we don't trade. Let's assume it broke through and move on. This is the new key level. And this is the old low. But the price hasn't broken past this old low and reverses immediately. It doesn't align with Fibonacci from 0.5 to 0.618, so we won't enter a trade here. I decide to enter a trade right at this key level. Take profit down to this old low. The price didn't hit my entry point. I missed this trade. At this point, the key level was here, but has now shifted to here. This is the new key level. Simple as that. In this market scenario, it moves like this. It moves like that, so this is the key level, and this is the old low. Fibonacci from 0.5 to 0.618. Here, it doesn't align with the old low. We won't enter a trade at the old low. Let's see if it pulls back up. Okay, it pulls back up, but it doesn't align with Fibonacci from 0.5 to 0.618, so I don't want to take the risk. I won't enter a trade here. There's no additional supporting factor. The price moves up like this, clearly. We enter a trade right at the key level. Stop loss a bit wider. Take profit at this old low for safety. Achieving a risk to reward ratio of 1 to 3.39. This trade hit take profit very quickly. But the price didn't continue down but reversed back up. It returned to this key level. So at this point, should we enter another sell trade? Right here? Sell like the previous trade? For me, I wouldn't do that. I won't enter another sell trade, even though our analysis suggests the downtrend will continue. It will move down to this key level. And the price shouldn't break through this key level. But why didn't the price continue down and instead returned a second time? Talking about the second time, it's like in life. The first time is always exciting, always thrilling and eager, satisfying. But the second time, pay attention. The second time, things are never as good. I don't like taking risks in this scenario. I won't enter a second trade. Even if it goes down, even if I miss the opportunity, I won't regret it. And indeed, it went down. The second time was still good, it went down. But remember, no regrets, no FOMO. Missed an opportunity? Find another one. We don't regret in this scenario. So at this point, has anything changed? The key level in this case is still here. Nothing has changed. Except the old low is here. This is the old low. The price pulls back. Let's measure Fibonacci again. Now the old low coincides with the 0.5 Fibonacci zone. This is a positive factor. I enter a sell trade here. Take profit at this old low, achieving a risk to reward ratio of 1 to 2.28. This trade hit the stop loss, and when it does, I'll enter another trade at the key level. Stop loss a bit wider. Take profit at the old low, achieving a risk to reward ratio of 1 to 3.8. At this point, the price still hasn't hit our entry point, and moves down like this. It moves down like this. No FOMO here. Missed the opportunity? So be it. Now let's apply what I said at the beginning of this video, the knowledge. When the price moves without a trend, it moves straight like this. Straight like this. It doesn't form highs or lows in this case. So what do? We drop to a lower time frame. Until when? Until we see it forming highs and lows, forming a market structure, and we can easily identify the key level. At this point, I switch to a lower time frame, the 2-minute time frame. My experience is that the 2-minute time frame confirms the 5-minute time frame. This is the 2-minute time frame. This area, it's a consolidation. Clearly no high-low structure. Doesn't look good at all. I don't consider this a pullback. I consider this a consolidation. Some of you might think this area is a pullback. You might think this is a pullback. I don't think so. Look closely at this. It pulls back for 2 candles. But by the 3rd candle, it's a strong green engulfing candle. An engulfing pattern. It feels like the pullback isn't strong enough, so on this 2-minute time frame, I also think it doesn't form a high-low structure. It moves straight up. So now, we move to an even lower time frame. The 1-minute time frame, the ultra-fast time frame. On the 1-minute time frame, it's like a painting. Like a textbook. No ripples or hesitation. The market moves like this. Because it moves like this, this is the key level of the uptrend. This zone hasn't broken the old high. This hasn't broken the old high. Remember, this is the 1-minute time frame. The lower the time frame, the clearer it needs to be for us to confirm. If this were the 1-hour time frame, this area might be a real breakout. But on the 1-minute, 2-minute, or 5-minute time frame, this area is likely just a false breakout. This is a false breakout. Let's switch back to my entry time frame, the 5-minute time frame. The price hasn't broken through here, so I don't need to worry or stress about the trend. It's still an uptrend. If it breaks through here, then we'll plan further. The price has now hit my entry point. And if you notice, if this were an advanced video, it's very likely I tell you to enter a buy trade here. We'd take profit at this level. But this isn't an advanced video. This is a basic video for everyone. We won't enter advanced trades. The price hit our entry, so we just wait. This trade is hit take profit. But if we manage this trade and move the stop loss, this trade would have hit break even, not take profit. But there's a stop loss management technique I recently learned. If we applied that technique, this trade wouldn't have hit break even but would have hit take profit. I learned that technique from a trading group. There's one thing I haven't fully mastered. I haven't practiced it much. I haven't tried it much yet, so I still don't understand that method, so I can't share it widely. But when I practice long enough, I understand that method, then I will share it widely for everyone. Okay, this order then. Management is break even. Without management it has hit TP. Continue observing. The price drops again. Before it was an uptrend, a retracement, but this retracement has ended. The downtrend continues. So I just care about the current downtrend. This is the new important key level. And this is the old bottom. Price seems to be on a retracement trend. It retracement, I measure this Fibonacci. That old one coincides with the Fibonacci. From 0.5 to 0.618 is a point plus. I continue to enter a sell order right here. DP, then I TP right too. This strong buy zone. DP here reaches RR ratio of 1 to 3.66. But in the end, its price doesn't hit my order point. It goes down. So here, I know there will be some of you who have questions. Why do I say that? When the price retraces, it will retrace to one of the following two places. Something important, key level old. Then why doesn't it bounce back? But it's like this, it's going down. Then for me this is not a bounce. For me, this whole price range is a sideways price range. But it hasn't recovered. We often make mistakes in this part. Counting the number of candles, 1, 2, 3, 4 green candles, thinking the price recovered, but it didn't. We shouldn't count candles. Counting candles is old-fashioned now. Then let's just focus on the first one. Here it goes sideways, sideways, sideways. Here it goes sideways too. But when we count that candle we think it's a bounce, but it's not a bounce. This whole area just goes sideways. This is just our vision. Just see. But the real price, it's still in this price range, it hasn't broken out. Remember, don't count candles, don't use the market sense. Look at what it's in front of. It's sideways. And that's the whole main content of today's video. Bye guys, see you in the next videos.